So I'd like to spend about 10 or 15 minutes discussing some of our thoughts and views and really outlook for 2021. A quick look at the status of the U.S. consumer is really a good place to start the outlook discussion. Given that the consumer is really the main driver of our economy. And in aggregate, consumers are well positioned. The household net worth is high given the stock market performance over the last decade or so, as well as very solid home price appreciation. Consumers also aren't very leveraged. Their debt obligations compared to their income levels is lower than it's been over the past 40 or so years. So, a much different picture than prior to the financial crisis or back in 2007, when consumers were just way over their skis in terms of debt loads or debt levels. So we think that sets up a positive picture going forward for consumer spending, again, really the main driver of our economy. And unsurprisingly, there's also a lot of pent-up demand. I think that statement shouldn't really shock anyone. There are obviously a ton of things that consumers can afford to do and want to do, but just don't feel safe doing right now. Things like going to the movies or getting on an airplane or a cruise are top of mind. But that picture should change and change dramatically once the vaccines have been widely distributed and we've reached some form of herd immunity by the second half of 2021. And, as our chart shows here, consumption or consumer spending has historically tracked, very closely with consumers' spending potential. That's held for the last 50 years. As spending potential goes up, so does consumer spending. That's what the U.S. consumer does. But a big gap in the present day situation because of the COVID pandemic. So we firmly expect to see consumption levels pick up and converge with that higher spending potential as the year progresses, which should also be a very significant economic tailwind. Let's talk a little bit about employment. Last year, the U.S. lost 22 million jobs between February and April. Just an absolutely unthinkable outcome. We've since clawed back about 55% of those lost jobs. We think, the process of calling workers back and adding new jobs, continues and picks up steam in 2021. And we think that, adding workers back to the payroll will be easier this time than in previous recessions. And this chart really, highlights why we think it will be, a bit different this time. So if we look back to 2008, the 2009 recession, and frankly, all of the recessions as well, we see a very predictable pattern. As unemployment levels spike, the ratio of job seekers, per job openings spikes as well. And it's not difficult to understand as people lose their jobs. They have to go out and find new jobs, and that process is challenged in an economic recession when there are more job seekers than job openings. But we've seen a really much different picture this time. We didn't see a spike in people looking for new jobs because they firmly expected to be called back to existing jobs. So we think it's going to be much easier to see an improvement in employment this time, given that many displaced workers aren't going to have to find a completely new job at a completely new company or a new career. So I touched on a number of the factors that should contribute to solid economic or GDP growth in 2021, a healthy consumer, pent-up demand, improving employment. This chart illustrates that we still have a lot of room before economic activity returns to normal or rebounds back to longer-term trend levels. We could see the significant plunge in GDP or economic activity in the first half of 2020. We can see the rebound in the back half of 2020, but still a fairly long runway for the current economic expansion to continue. As equity investors, we are very focused on corporate earnings. We view corporate earnings as the main driver of stock market performance over the long term. And as we're showing here, the annual growth in the earnings per share for S&P 500 companies. And, no surprise, we saw a contraction in 2020, which is represented by the smaller blue bar over to the right, second from the right. But expectations for 2021 are very healthy. Current consensus estimates are for more than 22% earnings growth this year. So, a very solid rebound. And given, how well companies managed their earnings during the downturn and the massive outperformance compared to expectations that we've seen over the previous couple of quarters, we wouldn't be surprised if actual results, came in even better than these high estimates. Okay, another positive, we should see measurable dividend increases this year. Thinking back to the first quarter of last year, we saw companies really, batten down the hatches and prepare themselves for the worst case scenario. A lot of companies cut or suspended their dividends and share repurchase programs. They also raised a lot of capital, mainly in the bond markets. Cash was certainly king, during the height of the COVID-related concerns back in February and March. But now, S&P 500 companies are flush with liquidity, holding record cash levels of more than $2 trillion. We've already started to see companies announce plans to return some of that cash to shareholders in the form of dividend increases and stock buybacks. And we expect that trend to not only continue, but also to pick up steam throughout 2021. So equity investors, should expect a raise in 2021. Okay, so I've talked a lot about positive expectations for the year. I'll wrap up with some thoughts on risks. And if we look back over the last couple of years, despite very real concerns about the China trade war in 2019 and the COVID pandemic in 2020, the stock market, measured by the S&P 500 index, is up a massive 55% over those last 2 calendar years. And undoubtedly, the significant decline in interest rates has been a major contributor to the strong market performance and also expanding valuations. But with interest rates so close to zero, as we show on our slide here, 10-year Treasury bond yields were below 1% to start the year. We just can't count on this trend to continue much further. The math just doesn't work unless we were to see interest rates move into negative territory, which is just not an outcome that we anticipate. So we could see this trend reverse to some degree this year with rising interest rates as the economy improves and as we issue more debt to finance large budget deficits. And that could certainly take some wind out of the sails of the equity markets. We'd expect a significant rise in interest rates to translate into a more competitive environment for stocks if bond yields were to become more attractive, and generally lower valuations for equities as investors just wouldn't be willing to pay as much for future corporate earnings in a higher interest rate environment. I've spoken a lot about valuations. Here's a quick look at how we're starting the year. And just to kind of walk through this chart a bit, on the bottom or the horizontal axis, we're showing valuation multiples or price to earnings ratios. As we move from left to right, it indicates that stocks or the indices is moving towards more expensive valuation levels. And on the left, the vertical axis, we're just showing a range of historical one-year returns, again, for the S&P 500 index. And the real point or takeaway of this chart isn't too complex. It's simply that historically, the starting point matters when we're looking at fairly short periods of time, like 1 year into the future. And when you start with low valuations, stocks are cheap. Historically, returns have been higher. And the exact opposite has been true as well. When we start with high valuations and stocks are expensive, future returns have historically been lower. And as the little red arrow on our chart indicates here, the S&P started off 2021 firmly in expensive territory, trading at almost 23 times earnings estimates. And historically, again, on averages, when valuations have been this elevated to start the year, returns have been just above the flat or positive line. So there are certainly other factors to consider, but we would certainly put valuations in the risks or concerns category. We think high valuations combined with bullish investor sentiment, it leaves markets vulnerable to bouts of volatility and corrections, if outcomes don't match up with pretty optimistic expectations. So, putting everything together, the good with the bad, we think that the massive amounts of liquidity combined with above average economic growth, above average corporate earnings growth, should be enough for another year of positive returns from equity markets. But we also think that the upside looks, more limited, more constrained compared to the previous 2 years, given, really the pull forward of returns that we've already experienced since March of last year. So 2021, looks to us like more of a mid-single digit return environment for broad market indices compared to, let's say, 25%, which is the rough average annual return for the S&P over the last 2 calendar years. And while that forecast might not be, too exciting, I'd also say, our investment opportunities are not constrained to only, broad market indices. We think that stock picking, stock selection will be a very, important determinant of portfolio returns this year, especially given, the huge divergence that we've seen in terms of returns and outcomes across different markets, sectors and different market styles like growth and value that we've seen over the last several years. And on the fixed income side of portfolios, we think it's difficult to expect the same type of tailwinds for bond returns going forward with interest rates, so close to zero. So we think that, investors will be, lucky to earn their coupons or returns on bonds this year. The math just does not support much more, price appreciation from bonds. Okay, so with that, I'll go ahead and wrap it up. I'll turn it over to Mike Blehar to coordinate our question and answer session. Thank you.